Why is consolidating SaaS profit and loss statements across regions so complex? Imagine trying to piece together a puzzle where each piece is from a different box and uses a different language. That's what consolidating profit and loss statements for software as a service companies operating in multiple regions feels like. It's not just about adding up numbers. It involves navigating a maze of different accounting systems, currencies, and legal rules. First, many SaaS companies have subsidiaries or branches in various countries. Each one might use its own accounting software, follow different reporting standards, and record transactions differently. When it's time to combine all these reports, manual work often takes over, usually through spreadsheets. But spreadsheets are prone to mistakes, omissions, and take a lot of time. This can delay closing the books and increase the chance of errors slipping through. Next, currency differences add another layer of difficulty. When a company operates in the United States, Europe, and Asia, it has to convert revenues and expenses into a single reporting currency. Exchange rates fluctuate daily, so adjustments are needed to reflect the true financial picture. If not handled properly, this can distort profit figures or hide real performance issues. Intercompany transactions also complicate things. When one subsidiary charges another for services or shared costs, these need to be identified and eliminated. Otherwise, the same revenue or expense might be counted twice, giving a false view of profits. This process requires detailed tracking and careful adjustments, which can be time-consuming and error-prone without automation. Revenue recognition is another challenge unique to SaaS subscription models. Revenue is earned over time, not all upfront. Deferred revenue needs to be properly allocated across periods and regions. Customer churn, or customers canceling subscriptions, also impacts revenue timing and accuracy. Plus, many SaaS contracts bundle multiple services, so revenue must be split according to standards, adding complexity. Different countries have different tax rules and legal requirements. Some regions requiring sales tax or value-added tax to be added to invoices, while others don't. Costs like research and development might be capitalized in some jurisdictions but expensed in others. These local rules mean that consolidating financials must be tailored to each region's legal environment, making the process more complex. Finally, many companies still relying on disconnected systems that don't talk to each other. This lack of integration slows down the process and increases the risk of mistakes. Without a unified platform, consolidating profit and loss statements across regions can take weeks, especially if manual adjustments are needed. That's why many SaaS companies turn to cloud-based financial management tools designed for multi-entity operations. These platforms automate currency conversions, handle intercompany eliminations, and support compliance with different accounting standards. They help speed up closing cycles, reduce errors, and give a clearer view of overall financial health. In short, the complexity comes from managing multiple entities, currencies, regulations, and manual processes. Using the right software solutions can make consolidating profit and loss statements across regions much smoother and more accurate.